Hello and welcome to another exciting episode of Finance Footnotes. My name is Brent Stransky. I'm here with my friend and colleague Zach Miner. Today is January 3rd, 2024, and we're going to talk with you about some exciting things going on in the market to kind of set the tone for what we're going to expect in 2024. I'm going to share some notes about where we are at the moment, how 2023 ended. It was a very positive note. And then talk a little bit about optimism that I see in the marketplace at the moment. Things seem a little frothy. And then turn our attention, of course, to the 8,000-pound gorilla in the room. That's the 2024 election. So I've got some notes here to kind of start our conversation. We'll be touching on that a lot more as the year goes on. Zach, what do you have planned for us today?
Yeah, happy New Year to you and everyone tuning in. It's interesting when the page turns on the new year, how the kind of sentiment can shift pretty quickly. I think that's happened several times in the last couple of years, and this year might not be any different. And as you mentioned, that's an election year now, so I guess it's time to start turning a focus to it a little bit.
Yeah, I think so. So coming to your point about sentiment, it does feel like, as soon as January starts, you're just flipping the page, putting the news, the good news behind us and looking ahead to see what's going on here. And I thought that might be a good time to kind of take a stance and look at where we are. So I have a screenshot here from the Wall Street Journal this morning, and there's the three major American indexes, which of course are the Dow, the S&P, and the Nasdaq. And I just wanted to point out, it's while the Dow yesterday, the first trading day of the year, squeaked out a new all-time high. That's my ATH abbreviation there. The S&P 500 is still 1.1%, and I think today's a bit of a down day too. So maybe closer to 2%, 2% off all-time highs. Now, why is that important? Well, last year was the first year that the S&P 500 didn't hit a new high. Zach, do you want to take a guess how many years it's been? Did you see this? It really, really
No,
shocked me.
I didn't. I'd say probably 2011,
Yeah,
12 years.
2012. So it was
12, yeah,
over 10
yeah,
years
11
that it's
years. Yeah.
been. Good guess. You get a gold star, I think. So we're still below that. And it's been 2 years since we've had a new high. And that was set in January. Gosh, almost exactly 2 years ago today, I think. Is that
Yeah.
right? Does that sound
Yeah.
about right?
Yep. Very beginning
Yep.
of 2022.
Yeah, I'm looking here on that chart. It says January 3rd, 2022. So 2 years ago today. And then
Yep.
looking at the NASDAQ, still 8% below all-time highs. So, it's been flattish for the last 2 years, best case, and slightly negative for the Nasdaq. So despite all the news we hear about the positivity in the marketplace, it's still been relatively flat for the last 2 years. So S&P year end, including dividends, up 26%. And Zach, this is something we talked about off and on. It certainly made its way in the news about the Magnificent Seven. Those are the largest tech stocks we hear about that you can name off the top of your head: Tesla, Nvidia, Google, Amazon, Facebook, etc. So if you subtract those out, the S&P 493, which are the other 493 stocks in the
The
index, were up.
mediocre, the mediocre 493.
Yeah, the less than magnificent. Um, we're up only 13%. So kind of more on trend. It's just amazing how those largest seven stocks really drug the index higher, much higher this year. So that, half the return were from those seven stocks alone. Crazy
And
to think about.
that really broadened out just in the last 40 trading days of the year, because it prior to December, that S&P 493 was essentially flat. So it
Yeah.
really did broaden out, and that there was a real surge of kind of the stocks that hadn't really participated much throughout the year. And the Mag 7 actually didn't really do that much at the very end of the year there. So there was a kind of a lifting of the boats, which is a positive sign for the market, that it did broaden out. But that really happened just in the last 30 trading days of the year.
Yeah, it's a great point. And it's something I want for you folks watching at home or listening in your cars. I just want to make this point. There's been a lot of prognostication about what's going to happen this year, any year going forward, right? But I think we should, in our minds, make a demarcation between, the top seven stocks and the index as a whole, and then the rest, the 493, right? I think the 493, in other words, could have a more positive year than the S&P 500 as a whole. So I think this is the year that we might see some backtracking or some better said, some catch up by the other 493.
Yeah,
So
backfilling and catching up. Yeah, and there's really two ways kind of for the valuation differences and for those performance differences to resolve. The first one would be for the Mag 7 to fall, and the second one would be for the rest of the market to catch up. And I think both of those have certainly things you could look at that would point to either one of those outcomes. But I think that our kind of base case is more for the catching up.
yeah, and I think it's just a good excuse as always to double down on diversification. So, in line with that previous statement, the Dow Jones up about 13% last year. And then I just have kind of a spattering of, conservative allocation, which is a, conservative minded investor, according to iShares, is up 10.8%. Moderate allocation, middle of the road, 60/40, up about 12.4. And then a core growth allocation up less than 16%. So just a stance of, or an idea of where we are. That being said, I want to turn our attention to optimism. We've been following this a lot, Zach, and I think over the last 9 weeks, the first time, this is another quiz for you. First time, I know you know the answer. The 9 weeks of positive returns on the S&P 500 and the Dow. When was the last time there were 9 weeks in a row of positive returns? Do you remember? Want to take a
That
guess?
would, that would be never, or has it happened before? It's
I
been a while.
it's been 2004. It's been 20
2004.
years, and
Okay.
there's been,
Okay.
which is incredible, right? So I'm going to come back to that in a second. But coming from the depths of October when everyone was pessimistic, I'll get to that in a second. To where we are today, it's funny how quickly our opinions and sentiment whipsaws around. So one note I
Absolutely.
saw here in the Wall Street Journal yesterday: fund managers most optimistic they've been in 2 years. Always a sign for you and me to take a step back and say, you know. We don't want to fall the herd over the cliff. Um,
Right.
and then just the American Association of Individual Investors, they publish weekly sentiment report based on their subscribers. It's often cited. It's their opinions of people just like me and you, Zach, or anyone else who subscribes, but what their thoughts are in the next 6 months. And I want to point out that while sentiment in the last week of December was the lowest it's been all December, still something like 47% of people were optimistic or bullish, and that's still 10% higher than the long-term average. So things are pretty frothy from that perspective. I also have on this chart here, it's the bull bear spread. And this is simple. This is taking the number of people that are optimistic and subtracting out the bears, or the people that are pessimistic. And it gives you kind of a net number. And you can see here, it's very peakish since that time. So I think we're looking at a case here where, there is some peak in optimism. Are you seeing that out there, Zach? What do you think?
Yeah, absolutely. I'm zooming in to see if that 5 year. Oh, it's the 1 year. Okay, so one
Yeah,
year
just the
bullish
one
high
year.
was okay. Yeah, and I wouldn't be surprised if that was a 3 or 5 year close to high. I mean, it really doesn't get too much higher than mid 50s, 60% on the bullish range. So it is a quite a large number for that.
Yeah. So, it's just a litmus test of where people stand at the moment. People ended the year very, at least from an investment perspective, very optimistic. Zach, do you ever look at the CNN Fear Greed Index?
Yeah, I do. I do, and it's interesting to how quickly it can change, right? I think that's
Oh yeah. Yeah.
the main point is how you can go from extreme fear to extreme greed pretty quickly, and it's kind of a proxy um for price action, for flows, and for sentiment, and
And
it just gives
momentum
you a
and
nice, yeah, it just gives you a nice, clean, easy to
graphic.
read graphic of kind
Yeah.
of where the momentum has been, and it's typically a pretty decent contra indicator.
I like it. It's a good looking indicator. It's easy to talk about. And you can get it if you want to do it at home, just Google or whatever your search browser is. We're not advocating for one over the other, but you can Google CNN Fear Greed Index, and it changes daily. It's a constituency of 7 major indicators. One of them is my favorite, and I talk about it before, Zach. It's the put call our index, right? How many people are buying protection versus, optimistically kind of flying blind into the growth category, if you will. So that's one of the 7 constituencies. The point I want to make on this graph here, and we're looking at, it does say extreme greed at the moment, and it's the very low end. It's a scale of 1 to 100, looks like a speedometer. And it's right at 75 right now, right between greed and extreme greed. So the point that I want to make is that we've been in extreme greed for a few weeks. But if we look a year ago, we were at extreme fear at 36, or just in the fear category. So it was a big change from even just the last 12 months. So I think that, just back of the napkin test here shows that, people are pessimistic. In January of 2023, the market had a great year. And it's just cause to wonder what's going to happen if everyone's already optimistic.
Yeah, absolutely. And I like this next one with the 9 week win streaks. And I
Yeah.
don't know
So
why I said
let's
zero.
bring it home. So
I didn't know
did
there was more than one. But yeah, it's pretty interesting when you look at the kind of strength begets strength.
So yeah, to bring it home. So we are always worried about optimism, right? If everyone's optimistic, we ought to, maybe think about doing something else. But that being said, is there too much optimism? So you'll know here, I cleverly changed the header of this particular chart to a question mark. Is there too much optimism? Because if we look to your point, there have been 9 win streaks. Performance after 9. How many are there here? Looks like about 10. 10 occurrences, 9 previous occurrences, 10 including the last one, where there have been 9 weeks positive in a row. And you can see, Zach, to your point, the median gain 12 months later, higher 80% of the time, and a 12.2% median return, average of 8%. That's pretty good. So yeah, momentum begets momentum. We'll have to wait and see.
And interestingly, that you can kind of look at the strength of the win streak performance itself. This latest one was the greatest by quite a bit, actually. The second greatest was in 1985, where it was 12.3%. This was
Yeah,
15.8. So
great,
it's a
great
pretty
observation. I didn't even see
pretty
that.
big difference. But if you do look at the ones that were negative to smaller, they weren't the biggest ones. So the most strong 9-week performances had led to the most strong plus 12-month performances.
So it's a great observation. I didn't even see that. So but interestingly enough, so what are the chances that the 10th week is positive? According to the last 9, well, only a third of the time is the 10th week positive. So maybe we'll get a
Right.
continuation of that trend this very week as we're speaking. So that being said, we talked a little bit about the markets where we are. It's been flattish over the last couple of years. And we talked a little bit about the pessimism and the optimism in the marketplace, particularly the optimism and how maybe it doesn't make any difference. Maybe there's a lot of momentum at right now, and historically that could be a good thing from a technical indicator. Time to turn our attention to the elections. I've got a couple primers here I want to share with you. Been putting this off as long as possible. Didn't even want to think about it in 2023, but here we are nonetheless. We have to think about it. Wall Street Journal had a great article in early December, Zach. I'm sure you saw it. And I have a chart here on the screen, and it's showing you kind of over the last 18 months, I would say, of their polling with their polling partners. And they do a pretty good, of course, polling has changed a lot in the last 15 years, but be that as it may, they ask in a 2-person race between Trump and Biden, they found that Trump, for the first time in a long time, pulled ahead 47% to Biden's 43%. Now, this is a general election. We're going to talk a little bit more about the specifics of the electoral college in a next slide. But then they had a 5-person race, and that would include candidates such as Bobby Kennedy Jr., Colonel West, etc. And then in that case, Trump was ahead even further, 37 to 31, a 6-point spread in the popular vote. Incredible to believe. And gosh, we'll have to see. It was the first time that Trump was pulling ahead in this particular 18-month period. So it seems like he's gaining momentum, and part of it could be here. I'm skipping ahead one slide, and I'll come back in a second. But did you see this, Zach? Has President Biden's policies helped you personally? And this is an early December poll, and I was really, really surprised. Only 23% said that he helped, and 53% said that they were personally hurt economically by
Yeah.
President Biden's policy. Wow.
It's interesting. There's a lot to kind of pull apart here. I think the first thing to note is that Trump's kind of core base of support seems to be more stable than Biden's. And when there is a potential third party candidate that, look, I mean, Robert Kennedy Jr. does kind of seem like he's going to stay through the general election and be on the ballots, and it does seem like he's going to pull more support from the Democratic side than the Republican side. It just seems like the kind of the Trump core 30, basically that 37%, right? A third of the country just will not vote for anyone else under any circumstances. So it's interesting that that's kind of the dynamic there, that this could really be the first election in a while where a third party candidate actually does make a very significant impact. But we'll see whether or not he does stay in the race, or if anyone else potentially makes it onto the general election ballots. It's unlikely, but it's possible. So I think that's kind of the first thing to pull apart there. The second thing is that I think the major change in the polling numbers really, it kind of starts in October, right? When the Israel Hamas war started. I think that regardless of what the administration says or does, it's going to upset a cadre of people. I think that there is a significant percentage of the Democratic caucus that is not necessarily anti-Israel, but is certainly not happy with how Biden has stood behind the Israeli response. And I think that's probably a big contributing factor to why his poll numbers have dropped so much, or approval ratings have dropped so much in the last
It's
60 days. The question is that resolved by election day? Does that recoalesce by election day? If we have let's say we have a ceasefire next week, right, in that war, and then by November it's essentially in the political rearview mirror. Not obviously there's going to be a long recovery for that region, but politically, does that rebound after that's kind of off the table from the rhetoric of the political season? Possible. Could that recoalesce around him and those numbers come back up? Certainly possible. And we've also, we've seen that polls are not reliable. We
very
go back
true.
to 20
Very
go
true.
back to 2016. I mean, it was essentially no question, right? Hillary Clinton was going to be the next president of the United States by the polls. So
Mhm.
you wonder if it's kind of the reverse of what happened before, where maybe Trump's support is overstated. Um, and when you get into it, when you get into that ballot box and you're by yourself and it's just you there and you press that lever, maybe you make a different decision when then somebody calls you and you're speaking to someone and telling them your opinion on something. So it's interesting. I mean, there's a lot of dynamics at play, and there's also a lot of time left before the election actually
So
happens.
and we're going to talk more about the I think there's a great crossroads here between statistics, which is one of our favorite topics, as well as polling, right? How did the data get it so wrong? And there's been some structural change in the way polling's been done over the last 15 and 20 years.
Yeah.
But we'll catch up on that in a different podcast, so stay tuned. A couple of the facts before we leave this particular chart. I'm just reading here off my newsletter, which I just sent to compliance yesterday. According to Quinnipiac,
Yeah.
um, so they created a poll. What percentage of American voters, both Democrat and Republican, want to see a different candidate other than Trump and Biden? 52%. So I think a place where most people can agree
Amazing. Yeah,
is that we
absolutely.
know we want we want something
One of the
different.
only things where people agree, right, is that we would like to have a different choice.
So, and then according to a Gallup poll in December, and just to your point earlier, since 1979 with Jimmy Carter, at this point in their presidential cycle, President Biden has the lowest approval rating at 39% of any of the previous presidents. Trump was 45, President Obama was 43, H.W. Bush was 58. So,
Right.
will there be a change? There's a lot of time, but there's more ground to cover, as it were. So. It'll promise to be interesting. We'll keep you posted here on Finance Footnotes. The last chart I wanted to bring here, the last chart I want to bring here on the politics as usual, is that everyone's talking about the presidential election, but I think the Senate is something that's more in focus. There are 34 seats up for election in 2024. 23 are either Democratic or left-leaning independents. 8 are considered competitive by an independent resource. So here I have a chart from the Wall Street Journal. This is really cool. They have it updated, I think, daily on their website. You can go check it out. They have the president, Senate, and House. You can see that, to your point earlier, Zach, about the polling, we're talking about, popular vote versus electoral vote. And you can see here that despite that, as of the 29th, I guess this is maybe updated weekly at the moment, they're still expecting President Biden to have more electoral wins, although it's very close. But in the Senate, it's much different. They expect the low end for the
Right.
Senate to be 50% Republicans, and then the high end 57%. So the best case scenario for the Democrats is to maintain 50,
It's a split.
50, but that's the worst case for the Republicans. So it looks like there's going to be at least a 3 or 4 seat pickup. There's a lot of time left, but that could certainly, dissolve some of the impasse in Washington. And I guess we'll just have to wait and see. And then the last thing, let me end on a positive. I'm sorry. Go
Yeah,
on.
this is actually a really important chart for policy, for economics, and for markets. And because the reason being is that markets generally function pretty well under either presidential presidential banner. But gridlock tends to work pretty well. A split government, either a Democratic president and Republican Congress or vice versa, because you just
Hmm.
kind of know that nothing
Yeah.
major is going to change, right? And no huge bills, that's going to change the landscape of an industry is going to really most likely get through. And so you kind of look at this and say, okay, well, what's and my prediction, right? We did the prediction show last week, was that we're going to have a Republican Congress and a Democratic president and
Mhm.
gridlock. But I think the most impactful thing that could happen, because it really does look, especially on the Senate side, it's just the math, right? It's just the seats that are up this time around, that the Senate is almost certainly going to remain Republican. The House is already Republican, and the range is there. They could lose it, but again, probably going to remain in Republican hands. So if the president goes Republican, well, now we have the clean sweep, right? And now we really do have the stage set for major pieces of legislation to come through, on the Republican side, and especially with a conservative Supreme Court. So there's just a lot of things for policy, economics that are really riding on the presidential election, because the congressional one does seem to be much more skewed towards the Republican side. So I think that is pretty important and interesting, and it does kind of make this election one of the more, I think, important presidential ones in recent memory, just because of the dynamics of the Congress, where there's a very, very good chance that remains Republican.
We'll have to wait and see. Just coming back to a point on the polling, I wanted to point out that I think the Wall Street Journal is middle slash slightly right leaning. So just take that into
Agreed.
consideration as we're talking about
Yeah,
these polls, um, at least compared to a lot of the peers in the press. So the last
for
point I
sure.
want to end on, and I'll turn over to you, my friend, is just a point of positivity. I'm trying to coin that term, but since 1929, 74% of presidential election years have been positive compared to 65% normally. So there is, for whatever reason, seems to be more positive years in presidential elections. And I know you've got a chart on that to talk about in more detail. So with that said, I will happily turn it over to you.
Yeah, absolutely. And I'm gonna move that chart up here. We'll jump into that one first. So election year history, yeah, 74% of election years since 1929 were positive. But if you actually go back to the first election year under a new president, so basically the first term year, where the incumbent was running, going back into 1950, the Dwight Eisenhower administration, it's never been negative. That first year of
Wild.
or the fourth year of a first term president, essentially. And kind of largely positive. There was really only, the Ronald Reagan one was, 1.4%. You had a 4.5% are in there, but a lot of double digit returns. Going into that first term election. Um, and the second chart looks at kind of pulling it apart quarterly, when it looks at essentially the first quarter of an election year tends to be weak, the weakest of the four quarters. So just some historical context for you. No year is like the rest, but it does tend to be the case that election years are generally positive. Election years and the first term president are more positive, and first quarters in those election years are generally the weakest of the fourth, although it is still positive.
So,
Going back, yeah,
so for you following along at home, this is a great chart. This is for new presidents, not reelected presidents, but man, there's some seasonality here. I mean, pre-election years, positive 90% of the time, and then the election year, that would be the fourth year of their term, positive 100% of the time. That's crazy. So,
yeah,
that's a pretty interesting indicator, Zach.
yeah, it is, and I'm sure you could. And there's a smattering of Republicans and Democrats, right? I think maybe an even split. Um, So it's interesting, try to kind of go back and see, okay, well, why maybe that happened. You'd have to go back and look at makeup of Congress and where we were in the economic cycles. But it seems to be through the 70s, right, through the inflation years, and through the 80s, where Ronald Reagan was cutting taxes, and even the 2000s, where the tech crisis, and 2008, right? So there's a lot of different environments where this has been the case. So that was pretty interesting.
Very
Um,
interesting.
yeah. So moving along to something non-election related, is you mentioned a little bit of froth in the market, and this chart came across my desk here, and It's kind of hard to see. It's pretty zoomed out. Going back to 1929, this is a logarithmic chart of the S&P 500. And if you look on the y-axis, what a logarithmic chart means is that it doesn't scale 1, 2, 3, 4, 5. It goes 1, 5, 50, 500. It's a way to compare data points in a exponentially rising series. So when data is going up in a very rapid rate, it's difficult to look back and kind of make determinations about trend when you kind of go back into history. And so what this does is it plots a linear regression for that basically 100-year history of the S&P 500. That's the dashed line in the middle of the market returns there. And then a 2 standard deviation channel. So 2 steps away of the average volatility.
Which
And
should
just
account
wait.
for 95% of observances.
Right. And that's essentially what it does. And it kind of just shows you that it spends very little time above that channel.
Or below
And
it.
that's or below it, exactly. And that's kind of where we're at right now. We are above that channel by just a touch, just a little bit, but we are above it. Um, you know, and I think it is important to look back into some areas. Like if you look in through the 1950s, I mean, it's scraped along the top of that channel for quite some time. So it's not like we have to go back to the bottom of the channel anytime soon. But it does just indicate, hey, it is a bit of an extended market. But then you do look at essentially the end of the 1990s, right? So we had 3 more years or 4 more years of 20+% returns before there was any sort of correction there. So it's not saying like, hey, we've peaked above this channel and now we have to have some sort of regression. You don't have to, but it is something to look at where you say, you know, is what's the kind of the future 5 and 10-year forward expected returns. It really doesn't tell you too much about like this year. But it does maybe tell you a little bit of something about kind of the forward 5-year or the forward 10-year returns, average annual returns over that period. And I would potentially say that that may be under the historical average, if you just kind of look at kind of this type of historical analysis.
I
Um,
think this is an amazing chart. I think it, and this is price data, not like earnings data, correct?
right. Yeah.
Yeah, I mean that what you just said, Zach. Maybe slightly lower than usual 5 or 10 year returns. That segues with a lot of smart Wall Street firms who have said the same thing. Vanguard, for example, is one
Right.
that predicts 10 year returns. 3-ish%, 4-ish%. Um, so, what can we do as investors? Well, you should talk with your trusted financial advisor about adding alternatives in your investment portfolio that may be able to perform well in lower return environments. So, just a little plug there for you and me, my friend.
Yeah, absolutely. But going back to the reason why it doesn't necessarily say anything about this coming year is the next chart. And then we talked about this on the prediction show, why I do feel fairly optimistic about the year ahead is just this cash pile that keeps building up. And the reason why I put it in here again is because it crossed the $6 trillion mark, piling up in money market funds. So $6 trillion in money market funds at current time, and rates are going to come down. It is even the Federal Reserve now talking about it. Rates are going to come down. This money market fund is not going to pay you 5% for much longer. And so where does that money go? Right, it has to go somewhere. And right, I mean that's certainly a reason to be optimistic.
And if I could just
For the
jump in
short
there,
term.
it's such a great point about cash in the sidelines. We made some good points last time. We're going to put a link in the description about hitting up our 2024 predictions, which we did 2 weeks ago. Where we talk about this in more detail. But I think a common question I'm getting from clients at the moment is how much are rates going to go down and when is it going to happen? So the Federal Reserve said in December they suspect on average, which is just an average of all the governor's guesses, 3/4 point reduction, 0.75% reduction in 2024 this year. And then if you look to what the market's pricing in, something like is it one like 6/4 point cuts. So
Yeah.
it's like the market's
Hmm.
expecting double that for whatever reason.
Right.
So that means that you should, if that's true, you should expect your money market rate to go down between 0.75% and 1.5% this year.
Yeah, absolutely. And it does kind of it depends a little bit on kind of how the curve acts. It's not like necessarily, when the Fed does something, it directly impacts some of that stuff. But it's pretty close. So that's a good proxy to say, like, hey, in June, if your money market is paying 3.25 now, are you still going to stay in it, right? And maybe you will, maybe you won't, but I would suspect that at least some of that $6 trillion, will find its way into the equity market. So it's just something to look at in the short term, whereas the chart before kind of shows a little bit more of a long term, kind of long term predictive value.
Exactly.
And finally, the last thing that I wanted to look at, and this is something I think we've peeked at before, but it always is something that's very interesting to me, is that when we're making these kind of historical comparisons and you're going back to say, okay, well, what did the market do in 2009 or 2001 or 1991? The market is very different, right? Just the mechanics of how the market is functioning is very different. And that's really being fueled in a large part by the trend for passive investments to make up a much larger and larger share of the total assets under management than active managers. And what this generally will mean is that market cap weighted uh, investments, S&P 500, and the stocks for which are at the highest weightings of them tend to get more and more of the flows.
The
When you're an
positive feedback
active
loop.
manager, yeah, when you're a positive feedback loop, and it feeds back in on itself. When you're an active manager, you're one of the things that people look for when they're looking for an active manager is something called active share, which is how much different are you than the index. And so by definition, they want to be if you want to have a high active share, you have to be different than the index, which means you can't hold the highest weighted stocks and the highest weighted percentages in your fund. So the less assets under management that are going to those funds, it just stands to reason that the whole mechanics of how we are looking at the S&P 500 have to change. The S&P 500, the top 10 stocks are making up a bigger and bigger percentage of the index. There's more and more dollars going to it, right? When you're looking at these valuation metrics, when you're looking at these momentum metrics, does it make sense anymore to make those historical comparisons and say, oh, well, compared to what it was in 2009, the S&P is doing this and being here.
Well,
So
for
I think
the
this is just a
and
very important
it's
thing
a
to,
great
to
chart,
keep in
and for
mind.
those of you who maybe not seeing it on the chart, if you're driving, for example, this is great. And so, for example, the passive share is about 53% as of when is this end of
And
November of last year,
yeah, yep, yep,
and if you look, it looks like it was about 20% in 2009.
yeah,
So going back about 15 years,
more
it's
than
more than
doubled.
doubled. And then the active share has gone from obviously 80% to 47%. So that's
Yeah,
incredible. And what it means to your point, Zach, is that all the data we just talked about investor sentiment, it's less punchy. It has less weight because people are passively invested. Whereas before, money managers, for example, I quoted that they're the most bullish they've been in 2 years. It means less because they used to be 80% of the market, and today they're less than half.
yeah. So I think it's just a really very interesting uh, market mechanics change. And this is gonna there's no sign that this is going to go the other way, right? And there's no sign that this is going to change in direction of trend. And so you kind of just look at S&P 500 trading at X multiple. Well, does that mean as much? Because every share, and now there's 53% of every dollar, and I'm not just saying every dollar is going to the SPY, right? It's, there's many passive ETFs, but on balance, right, a larger and larger percentage share of every dollar is going towards that index-based strategy. So naturally, the index-based strategy is going to continue to rise in price. So it's very interesting when you're kind of looking at these historical comparisons to keep that in mind.
Well, it is a great chart, and I think kind of pull it all together and summarize. We talked a lot of data points, but just a bullet point what we talked about last time in our predictions. I believe, although subject to, of course, correction and apologies at the end of the year, but I believe that we're going to be up between 10 and 15% this year, and that's following the trends of some very important Wall Street analysts. We talked about that last time. Check that podcast if you haven't already. But the balance of data suggests that markets will continue the upward momentum this year, at least from my perspective.
Yeah.
Well, that being said, folks, thanks for your time. We'll look forward to seeing you next time on Finance Footnotes.
Take it easy.